Good evening once again. Now I'm coming up with a concept called participatory notes. Indian economy, um, money and banking sector. This participatory notes, especially capital market segment, participatory notes are very important. So make sure that you are very clear with this concept as well. So I would request you for any future updates and notifications, kindly subscribe this channel, and I keep posting maybe 10 minutes video, 5 minutes video, whatever it is. But my focus is to give you the material first and open the material and start going through when I'm explaining, and make sure that you use headphones and start listening to this lecture. All right. Okay, now most of you must have not heard about this participatory notes, but first of all, you need to understand that this concept is related to stock market and the investments foreigners, the investments which are made by foreigners in Indian companies or Indian stock exchange. All right. Before that, so what are participatory notes? Yeah, look at this now. Let me first tell you one very important thing. These participatory notes are also called offshore derivative instruments. Um, in other words, they're also called P notes. Okay, it says these are the instruments which are used. I repeat, these are the instruments which are used by foreign investors. That means the person who lives in abroad who would like to invest in India. To invest in Indian securities market means a foreigner who wanted to invest in Indian stock market, and if in case he wanted to invest in Indian stock market or Indian companies, he must get registered with SEBI, Securities Exchange Board of India, through which he might start purchasing shares, bonds, and derivatives. In my earlier lecture, derivatives is a separate concept. I'll explain to you. Until then, you understand it's a future contract. Definitely, these derivatives are one very important option where a person comes to an agreement with another person to postpone the risk when you are trying to have a contract with somebody to purchase shares and bonds to postpone the risk. That kind of fund is also called hedge fund. Okay, we'll see those types of funds and derivatives in detail in the other video, other lectures. So right now you focus on what are exactly these offshore derivative instruments or participatory notes. Right, I repeat, this is an instrument, a financial instrument, which is used by foreign investors. Means a foreigner who would like to invest in Indian company stock market. If in case he wants to invest in Indian company in Indian stock market, he or she or any organization is supposed to get registered with SEBI. If in case they are not registered with SEBI, foreigner or foreign investor cannot invest in Indian stock market. Right? Look at this. Now, before you can understand the entire theory, only if you could understand the first chart. I made it a little simple here. Please do focus on this. Okay. Look at the, let's say for example, there is one enterprise called MU Enterprise. MU Enterprise, which is willing to invest in X company in India. I repeat once again, MU Enterprise is willing to invest in X limited company in India. If it wants to invest in Indian company, my question is, this is an enterprise, it has decided to invest funds in Indian company which is called X Limited in my example, so that has to get registered with SEBI. Am I clear? Unless and until it is registered with SEBI, and moreover, remember, any investment that is actually coming from foreign countries can come in the form of two. One in the form of foreign institutional investor, or another one when foreign institutional investor invests in stock market in Indian companies, we call it as foreign portfolio investment. So it's like, I want to put it in a simple language. If a foreign company wants to invest in Indian company stocks, there is foreign portfolio investment that normally comes through foreign institutional investors, the institutions which are authorized to invest in Indian stock market. In other words, when I say foreign institutional investors who are authorized to invest in Indian stock market, Indian companies, which means they've already got registered with SEBI. That is clear. So in my example, MU Enterprise would like to invest in Indian company, that is X Limited. So there's directly it has to go to India and invest. To invest in Indian company, it has to obviously get registered with SEBI. Just for the sake of one investment in one company, it doesn't want to go through the big long process of getting registered with SEBI. Am I confusing? I repeat, if MU Enterprise wanted to invest in India, it has to get registered with SEBI. And getting registered with SEBI is not an easy task. Just for the sake of one time investment, which I'm trying to make an Indian or Indian company, why should I get registered with SEBI? Because I'm not going to do it regularly, right? So, therefore, there is a company called UK Enterprise Company which is registered with SEBI as FPI. It is a foreign portfolio investor who's registered with SEBI in India. Am I clear? UK Enterprise registered with SEBI in India. So what happens is MU Enterprise will have an agreement with UK Enterprise, and UK Enterprise. Look at here. UK Enterprise will purchase shares in Indian company in India because it's already registered. It has the registration. It is allowed to continue investing in Indian companies. Clear? Excuse me. Say for example, in my 1,000 US dollars worth of shares, because it's a foreign money, so in terms of foreign currency, it makes a payment to Indian company $1,000 and takes the shares worth of US $1,000. So shares are given to UK Enterprise by Indian company, which clearly means shares are in the form of, sorry, in the name of UK Enterprise. Any confusion? So UK Enterprise bought the shares for MU Enterprise, and the shares are in the name of UK Enterprise. But UK Enterprise is holding the shares for MU Enterprise. It's like this: there is a contract between UK Enterprise and MU Enterprise. This contract, MU Enterprise has to pay $1,000 to UK Enterprise. This $1,000 is called consideration when you buy shares. This is given to Indian company, and UK Enterprise will continue to be a registered holder in Indian company. So Indian company will maintain a register. In this register, whose name is there? UK Enterprise name is there. Then any profit or loss or sale of X Limited, that means one fine day this X company shares which are bought by UK company for MU Enterprise are sold in the market, definitely the loss or profit will be transferred to what? MU Enterprise. So there are four important things. Look at this. MU Enterprise is paying the consideration when UK Enterprise bought the shares for MU Enterprise. MU Enterprise would receive the sale consideration. That means whenever the shares are sold by UK Enterprise, then whatever sale proceeds, revenue that is earned by the selling of the shares by UK Enterprise will be transferred to MU Enterprise. MU Enterprise is entitled for any profit or liability. So if UK Enterprise has sold the shares of this $1,000 over a period of time, whatever profit that will be transferred and whatever loss that has to be borne by MU Enterprise. And UK Enterprise is just a mediator and holding shares for the benefit of whom? MU Enterprise. The contract that is made between UK Enterprise and MU Enterprise is basically a participatory note. Since it is not happening in India, since it is happening outside the country, since it is happening by outside the country, that is, investor is there outside the country, because MU Enterprise is there in Mauritius, so it is called offshore derivative instruments. Clear? Just rehear it once again and look at this chart, you will understand. Then if you don't understand this chart, it's quite difficult for you to follow these points. Now look at this now. What are participatory? Participatory notes are regarded as MP notes. They are instruments issued by registered foreign institutional. In my example, who's registered foreign institutional investor? UK Enterprise. They have got registered with SEBI. They will be investing in Indian stock market in Indian companies. Am I clear? These notes are issued for overseas investors. Overseas investor is who? In my example, MU Enterprise. They don't have to register. Maybe the reason why they're not inclined to get registered, there are a lot of procedures and policies to be followed, and maybe they're not regular investors. They would like to invest just once. In the year 2007, the percentage of participatory notes, that means foreigners investing in Indian stock market through this kind of a mode, is 50%. Just imagine, incredible. I mean, heavy amount of this one. Participatory notes are also regarded as offshore derivative instruments, as they're not happening within India; they're outside India. They are used by the clients of foreign institutional investors who do not wish to participate directly in Indian market. That means these MU enterprise, they don't want to participate directly in Indian stock market. They are used by foreign portfolio investors or foreign institutional investors who have actually got registered with SEBI. All right, who are these institutional investors? These are the entities like outside India that are they're responsible for making investment proposals. And I understood these are the institutions which are there. Their home country is different, and they wanted to take the proposal from different peoples who would like to invest in India. I repeat, these are the institutions outside the country. They will take the investment proposals from different segments and different countries who would want to invest in India. So, simply speaking, in other words, they are the machines who are actually bringing money to us. There are over 1450 financial institutions, foreign institutional investors registered as per SEBI latest data and SEBI regulation. So, with regard to participatory notes, participatory note is basically what the agreement that has been entered by these two companies. That means if you want to participate in Indian market, this company had to have an agreement. This agreement will be shown by this company to invest. So, in future, the investment of MU Enterprise is going to be safe because they are investing through an enterprise which is already registered with SEBI, and they have no other option. Simply speaking, they are beneficiaries. That means UK Enterprise is a mediator who's actually taking care of MU Enterprise. Since they are registered, there won't be any issue at all. Then, what are these SEBI regulations? Each of the foreign institutional investor can now invest up to 10% of the equity of it. So, any foreign institutional investor can invest up to 10%, subject to overall limit of 24% on investments by all financial institution owners. Overall investments that can come through foreign institutional investors in this regard is only 10% in any one single company. If in case that goes beyond 10%, definitely what happens is that becomes an FDI. There are other rules for FDI, foreign direct investment. We'll see that later. The foreign institutional investors have been permitted to invest 100% of their portfolios if it is debt securities, in the sense debentures and bonds. So if it is portfolio, that is, if it is a stock market in a company, they can invest up to 10%. If it is debt securities, that means if the shares up to 10%, if it is debentures up to 100%, they can invest. That means Indian company debentures. Suppose if an Indian company has issued debentures worth 100 crores worth, they can invest, no doubt about it. But if an Indian company has invested 100 crores worth of shares through FIIs, they can invest up to only 10%. These are eligible under SEBI, are permitted to include endowments. I mean, FIIs are basically the entities which are registered in the form of endowments related to culture, religion, etc. University funds, foundations, charitable trust societies registered with a statutory authority of their country. I mean, these foreign institutional investors, these are the institutions which are in these forms, and they've already got registered there in their home country, and they have a track record and a history of at least 5 years. Unless and until they have a track record of at least 5 years, they are not allowed to invest in Indian stock market up to 10%. Then what are the advantages? The participating notes play an important role. About 45% of the total investments are made through these notes in the recent past, close to almost 50%. So definitely this is helping us, bringing a lot of investment to India, but it's very dangerous if it is not properly regulated. There's every possibility it can become a black money transfer through official registered agents into this country. What are the advantages? Number one, any entity can invest in participatory notes. If they want to invest in Indian companies, they don't have to get registered with SEBI, because the FIIs have already got registered with SEBI. They will take care of everything. And from this participatory notes are also enable the large hedge funds. Hedging means transferring the risk. Until I explain in the next video about hedge funds and type of all the funds that are normally used in Indian stock exchange, please do understand that participator notes also enable large hedge funds, in the sense uh, they help transferring the risk for a future. Then participatory notes are transferable through endorsement. I mean, if you want to sell, transferable in the sense, if you have a contract with some FIIs wherein you have decided to buy some shares, and you can sell that contract because it acts like a derivative. Through endorsement means you can just sign it and transfer it off and sell it off to others, or by delivery without, if in case it's a bearer one, as by mere delivery also you can sell. I mean, endorsement is something where you just sign it across or sign at the back, like a negotiable instrument act. We'll see, suppose if you want to transfer check, you have to sign at the back and transfer it to others. Just like that, these promissory notes, which are basically contracts, can be transferred either by endorsement or by delivery. That means they can be sold and bought. So MU Enterprise can sell these agreements, the derivatives that they have, to anybody in future, because they have agreed to, they have a contract with the other enterprise to purchase shares, and in future ups and downs can happen, price fluctuations can happen. If they want to minimize, yes, they can definitely try to use them for a trading purpose. Some of the entities uh, route their investment through participatory notes to take advantage of tax laws. There are a lot of tax exemptions in different countries. Therefore, many people have shown a lot of interest in participatory notes segment as one investment option. Given definitions here, please go through these. There are a lot of, like, mutual funds, collective investment schemes, hedge funds, derivatives. I will cover it in the next video. If in case you are already aware of it, please go through these definitions and have a knowledge. So once again, I'm repeating once again, there's a company in abroad. This company would like to invest in Indian company stock market. There is a lot of 10%, and this company, since it is not registered, it cannot go directly to Indian stock market and invest. So it will approach an enterprise which is already registered as an FII, foreign institutional investors, or foreign portfolio investor, and foreign portfolio investor will act as a mediator. So the contract or agreement between this enterprise and this enterprise is basically offshore derivative instrument or a participatory note. That's all in this. Thank you. Have a nice day.